Super. Good evening, everyone, and thank you for spending your Sunday evening with us. My name is Lavanya, and today I am joined by two absolute stalwarts in the financial services industry, Miss Mehra and Ms. will be sharing all their wisdom on what one must do when it comes to not just making wealth, but also preserving it. The topic for today is how to get wealthy at any age, which is very seductive, I know. I will say that the reason we chose that topic was so that we could get more of you to come and join us. But we will be talking more about how to hold on to the money that we create and also wealth through the ages. So I'm going to start out by asking both of you, right? Like, how would you define wealth? What is wealthy today, right? Like in your minds, it can be philosophical, it can be a number, it can be a formula, whatever. But I'm really interested in knowing, can we put a number on what wealth really means?
I think if you, at a philosophical level, you would say that wealth is beyond numbers. But all of us need a certain minimum number to be happy and contented. Like in the US, it shows that something like up to $70,000 of income every year brings you additional happiness. And after that, your happiness is independent of the money. So that the threshold typically is quite low on what you need to remain content. But when you talk of wealth, it is not just that year's income. You're talking about having enough of that income for the rest of your life to maintain whatever level of lifestyle you want to maintain. So that is what brings peace of mind. So that's probably what you should be aiming for, that whatever is the level that you are happy at, that level of spending you can maintain for the rest of your life.
Yes. Rohit, what is
Yeah,
wealth to you?
so I would like to just extend that argument which Devina has given. So in a more practical terms, so wealth is a number. So even a billionaire can feel poor, and somebody who's not even a billionaire can feel rich. So I think the hack there is that if your wealth, in terms of your savings or investments or assets, whatever you may call it, if it's more than your needs, you're wealthy, right? And it's a moving number. So even if, for example, you are a billionaire, but your needs and more importantly, your wants are actually much more than what you have, you will not feel wealthy. So I think that is a very important aspect, when we relate with the real life context.
Yeah. So thank you for sharing your definitions. The other thing, okay, let's say that I do know what's going to make me happy, right? Like if I pay rent for a certain house that I'm living in, and if I'm anticipating to travel perhaps once every couple of years, if I want to spend so much on groceries, food, eating out, like let's say I have a vague idea of my expenses today. If I were to kind of project that into the future, and I'll ask you this question, Rohit, because you do address it in your book. Um, what are the things that I need to take into account if I want to aspire to a certain level of wealth? Saying, okay, when I'm 50, I want to go to Europe once a year. You know, or when I'm 50, I want to live perhaps in a smaller place. I want to downsize my life, and I want to perhaps live a simpler life. And let's say I have a vague idea of where I want my life to be at the age of 50. How do I kind of calculate what I need to save to get there?
50 seems to be the outer limit of your imagination that you downsize at 50.
Yeah.
Very important question, Lavanya. Thank you for asking. And so, see, the answer to this is, more mathematical in nature, because here we're trying to quantify our needs. So, first of all, we need to make a list of, all the needs as we envisage today, for which we need wealth, to fund those needs. And this could be protecting our lifestyle, which is our monthly expenses, the way we are living. It could be around certain assets that we wish to acquire in a foreseeable future. It could be needs around investing into the growth of a family, which is education and healthcare. And it could be around the future events as we envisage, which could be around weddings or celebrations and so on and so forth. But whatever you may do, this is a moving target. You cannot be able to envision if you are 30 what is where you're going to live at 50. So this is an exercise which you have to do perhaps every year, and it has to be a very simple exercise. Just make a list of your expenses, which is basic, nothing else but the needs which you need to fund with your wealth. And if you really want to go deeper, then you project those with expected inflation 20 years down the line. That's the future value you need. And if you understand it, or you have somebody, a friend or some advisor who understand mathematics, that person will help you to discount that at the growth rate at which you can grow your current savings to the present value. So that's the amount of wealth which you need. If invested at that growth rate, will become that future corpus which will fund all your requirements for the rest of your life. But this is a moving target, and you have to keep on revisiting this plan every year.
Yeah, I think over here, what I'm really taking away is that we have to get comfortable with what we are spending, with what we want to spend in the future. Because a lot of times we think, okay, we'll take care of it when the time comes, when the time comes. But, sometimes when the time comes, you're not prepared for it. Whereas if you're constantly visiting your own finances and going through it, I think that's a much more fruitful exercise. Whether or not we reach that target, I think getting more comfortable with your finances is a positive outcome. And because we were speaking about needs versus wants, right? Like Devina, we spoke about this yesterday as well. Um, when I think about the pitfalls, right, that lies in the path to wealth creation or generally accumulating a corpus of savings, today's generation has more pitfalls than ever, right? We have more distractions than ever. So what are some of the pitfalls that you see, especially in this generation of 25 to, I'm going to say, even up to 40-year-olds, anybody who has an Instagram account today? What are some of the pitfalls that are there, and how do you see lifestyle spending? Because I think that's also become a big chunk of spending for a lot of youngsters, right? Because they, like you said yesterday, a lot of the iPhones that are being bought in India are being bought on EMIs.
Yeah,
Right?
something like 70%. That's the data I saw of the iPhones are bought on EMI. Just a generation ago, Indians had this reputation of being savers and not borrowers. Now, if you see, the borrowing load on Indian households is quite high compared to the income level. And while it's fine to look at Instagram and all that, of course, it's a distraction is another matter. But there is this also this urge to replicate everything that is out there, whether it is buying of these things or having very fancy weddings. I mean, again, wedding spending has gone through the roof because everybody wants this picture perfect thing. And if you have the money for it, it is fine. But otherwise, there is no point jeopardizing your financial future with this. And it is very hard coded within you. One article I had written was that on exactly this, that why is it that there are these queues to buy the latest iPhone when most people in the queue would not be able to tell you what is the difference between the last model and this model. Why Gucci bags and Tumi bags? I had to Google what Tumi was. But I read somewhere in LinkedIn someone saying that I bought this Tumi bag and I feel happier because now I fit in better in my office. So this is something very deep coded within us. The deep coded part is not the wanting to spend. It is the wanting to fit in, wanting to be part, to belong to a tribe. And this has come out of, not now, this has come from the time we were hunter gatherers living in caves, because the human evolution has been for two things: survival and procreation. So if you chose to be out of the tribe, you did not procreate, you probably did not survive. So we are our ancestors were people who chose to stay with the tribe. So it's very hard coded within us. It is very uncomfortable to be outside the tribe, whatever that tribe is. The tribe may not ask you to buy Gucci bags, it might ask you to go with a jhola and torn jeans, then you will follow that dress code. But whatever your tribe is, you want to belong that there. So you have to consciously kind of hold back from there and think of the well-being of not you today, but also you 10 years, 20 years hence. And all of you who are young, two things I would say. One, start saving and investing early, and investing sensibly, not going into day trading, derivatives. So those are the things. Don't go to extreme ends of the risk spectrum. So don't put all your savings only in tax saving schemes and fixed deposits, and don't think you can become a crypto trader or a day trader either. Both are traps. So you have to be somewhere in the middle with a sensible allocation. And the sooner you start, the less you have to save every month to reach that target at 50 or 55 or 60.
Absolutely. I think that's gold over there. You want to get started on that habit very soon. So as your income sort of grows, the savings habit is already established. From there, it's just bumping it up versus, starting from scratch all over again. But I'm also going to quickly segue to Rohit because again, we spoke about lifestyle spending, and there is a fairly comprehensive section about it in his book where he talks about ego versus self-respect. Can you just talk about that and how, what is a framework? Like, because like Devina said, you do buy things to fit in. And when you're in a corporate office, like I see people who are younger than me, 25-year-olds, their first bonus check comes, right? And it goes into like some bag because they feel like, okay, this means like I've really made it in my life. When I bring my little Marc Jacobs bag or Gucci bag or whatever into the office, they feel like they belong and they think that feeling of belonging has value, right? Can you suggest like a mental model based on what you've written in terms of when is that kind of lifestyle spending perhaps valid, or when can it really open doors for me versus when am I just indulging myself or falling victim to peer pressure, right?
Yeah. So this is a very interesting chapter. It tries to first of all explain the difference between, us, where the source of happiness lies. Is it external or is it internal? If it is external, which means if you are seeking validation for us, then it's called ego. And if our source of happiness is internal, it's called self-respect. In true English language, that word means is self-respect because we are able to appreciate who we are, right? So we are not looking for somebody else to recognize us, give us an award, give us a prize, or external validation about who we are and what our strengths are and weaknesses are. So in that case, if you're driven by self-respect, if your self-worth is higher, about your own appreciation is higher, it leads to building your net worth. But if your decisions, in terms of even buying, are driven by seeking or conforming to external validation, for example, some of the luxury brands, there's nothing wrong about buying luxury brands, for example, don't get me wrong, I'm not against it. But if you are going and buying a luxury brand more as an appreciation of maybe a refined taste, that is your own choice because that's your own call. But if you're buying that to be counted into a tribe, as Davina explained, or more to seek validation from your peers as that you arrived in life, no, that's a wrong decision. That's more driven by ego. And if that is happening, then eventually you will see that your wealth will keep funding your wants more than needs. And a stage will come that you will start overspending than the wealth which you have. The equation of wealth will actually flip. Your wants will be far more than the wealth which you have, and over a period of time, you will consume your entire wealth before your entire lifetime. So that's what the aspect with this chapter talks about it.
Yeah.
Okay, so I'd just like to add to what Lavanya said that I spoke about starting to save and invest early. Sometimes people say that my salary is too little, I can't save 20% of my salary. So start with 5%, but then promise yourself that of the increment and the bonus you will save 70%. So that's an easy way to get started, that whatever increment I get, because otherwise lifestyle inflation can just eat up everything. And I'm not of that mindset that, like, people say that, oh, if you don't have this coffee every day you will save so much, and if that invested will compound. But in all the indulgence part, really think about what exactly what Rohit was saying, that is it something that gives you pleasure, or are you doing it to show everyone?
Yeah.
And like when you are getting married, concentrate a little more on the decision of getting married rather than you know
Then the photo
the
shoot.
perfect, yeah, the photo shoot and the perfect music for the entry and all those things.
Yeah.
So
Yeah, and data now says that the average cost of an Indian wedding is about 37 lakhs, which I think is really crazy, right?
Yes.
Considering our country. And one other thing that I wanted to kind of add to Rohit's point was that if we are constantly chasing validation to be liked by everybody, then I think we'll have to spend our lives doing it, because everybody won't like you. Like, you can't please everyone, and so if you go into this whole loop of like trying to please everyone, then you end up pleasing no one. So and
And there's always somebody on a rung above you.
yeah,
So
yeah,
please look at how many people are below you and how many people would be absolutely delighted to have the life you have.
yeah,
Then,
there's
and you will always be, unless you become the richest person in the world. And even then, that post, that's a kind of, you can't hold on to that for very long. Also, you will soon slip to number 4. So if you're forever in that who is ahead of you, you will never be happy. So better to
yeah,
look at all the things you need to be grateful for, what you are blessed with.
yeah. Just look at Bezos, guys. He's not number one anymore. But I want to get it back to that point that you'd mentioned of saving early, right? Now, let's say I'm a 22, 23, 25-year-old who's saying, okay, I'm not even making enough money. But I've decided, like, okay, I'm going to invest, sorry, between 5 to 10% of my salary. Now, in my head, this is a very small amount. But do I take a DIY approach, or do I go to a professional early in this stage? Do I start by seeking professional advice, or do I start by perhaps reading Live Mint, looking at top 25 funds, closing my eyes, picking three, and then saying, okay, like, I'll split my 7,500 as 2,500, 2,500, 2,500, and see what happens. So, because there is a lot of DIY investing that youngsters are doing today, I'd like to know, like, both your thoughts in terms of how should one approach it, especially when they're just starting out.
So I have a chapter in the book which is should you be a DIY investor, which is of course talking about investing in stocks directly. But if you have investing a small amount, the main thing is to just get your broad asset allocation right. So when you are very young, probably you can put 70% in equity, and maybe 10% in gold and silver, and 20% in fixed income, which can be fixed deposit, which can be tax saving schemes. So that's enough at that stage. So you just pick a few good. Don't try to get into specific themes in equity mutual funds. Do it on a broad multi-cap, flexi-cap basis. So to that extent, you can do it yourself also, because there will be websites who can guide you with that. But if you are picking stocks on your own, when you are doing it with small amounts and with very little time being invested, most of the time you will not do as good a job as a professional will. So I would advise that you go to uh, somebody who is actually managing money for a living, not when you have a day job and you're doing it half an hour in the evening.
Yeah. Your thoughts?
Yeah, so I would say that first of all, on the habit part, Devina was very kind when she mentioned that 5% accumulation. I would not be so kind. I would say from your first paycheck, whatever age you are at 22, 23, 24, 25, 10% is as a discipline you should carve out. And the simple rationalization of that is that if you are working, then there is also a 10-12% deduction happens towards provident fund. So if that is going, towards a government statute, then this is something which you decide that you're going to pay yourself first, 10%. And irrespective of the amount, it is not that, with this 10% you're expecting to build a huge amount of wealth, but this is an atomic habit which you'll invest from the first paycheck of your life. If you have done that, then as you get into 30s, your income and expense gap is going to widen. So this 10%, now that you're used to accumulating, can go up to 20%, 30% as you go into your 40s. This will become your bridge to wealth creation, because you've got used to, you build a very good habit to pay yourself first. And coming to your other part of the question, Lavanya, yeah, see, when you're starting your journey, it's always good to build knowledge about what you're doing. Uh, Good thing which has happened with digitization and the internet world that we live in is that access to knowledge has got democratized. Your knowledge is no more within the four walls of the hallowed universities. right? It's all available, it's very, very accessible. There could be books, written by experts like Devina, experiences which I have shared. More than the books, there could be courses available, right? And there's enough knowledge on YouTube. But then that is the initiative which you have to take to educate yourself. But if you can find somebody who's an expert, although in the initial journey it may be hard because the industry is still growing, it's a good idea to have somebody who's does it for a living to advise you. For example, you can find access to medical knowledge on internet, but it's always good to validate that with a doctor. So I think a balanced approach where you are also taking your own initiative to educate yourself about personal finances to be validated by an expert, I think is a very good approach as you're starting out, because then you are a conscious investor. You are an informed investor. You are not just an influenced investor. There's a huge difference between the two. So you have to be an informed investor and not an influenced investor.
Absolutely. I think
I
if
mean,
I
the
were to get a
reason
bit more,
why I said that get started with something is that a lot of people freeze and think that unless they understand everything, they should not start. I did a podcast for a large public sector company, and they said like a lot of our people reach retirement age and find they're mostly in fixed deposits and PF. And because every time they thought, ye samajh mein aayega, once I understand this, I'll get into it. And that time just keeps passing. So just get that broad thing right, and then of course you should educate yourself. There's nothing like learning, nothing like being able to be a smart decision maker, even to decide which advisor or which professional to hire.
that's really what I want to get into. If I were to get a bit granular, right? Who is the expert here? Because I was a chartered accountant in practice for about 7, 8 years, and I remember clients who used to come to us for tax filings would also ask us for investment advice. And I would have to like really sit down and explain to them, saying like, I am not the right person. But the perception is that because you are a finance professional, you have the breadth to advise on anything that's related to finance. So I wanted to kind of have both of you clarify as to who an investment advisor is and what are the qualifications that an investor should look out for when they are choosing an investment professional. Because these days, people just walk up to anyone with a finance degree and ask for investment advice, and there is a good chance that the person on the other side will give it also. So,
I mean,
how would you describe?
surprisingly, a lot of industrialists and family offices take advice from their CAs.
Yes.
Respective domains. You cannot go to a cardiologist to get an medical advice on cancer. So it's as different as specialized as that. So I think coming to whom should you choose? So first of all, I'll ask you a question that when was the first time when you wanted to know which doctor to go to, which physician to go to, which lawyer to go to, which architect you go to? What is the bridge? You would have reached out or called some of your friends, right? You would want to have the benefit of finding a professional based on somebody's validation, real life experience, right? So within your network, you also seek those professionals who have been used by your friends, who are known to them. And if experience is good, then go and talk to them. And of course, in terms of qualification, there are certain certifications, which provide domain knowledge. So see if they have done CFP, see if they have done CFA. These are, but everybody may not have done it. What is more important is that somebody has been doing this for a minimum period of time, say at least 10 years, and they have built a track record of happy clients, happy investors, right? And that is the biggest qualification, that these are the a professional. This is the professional which can be trusted because my friend is happy about it, my relative is happy about it, because it's a business of trust. It's a business of deliver performance. So that's how I think initially you should go about it, and then based on your own experience, you should pivot.
And one thing which you should make sure is that whoever you are dealing with, they may or may not answer you honestly, in which case you need to be even more careful, is that how much commission are they making out of any product they are recommending to you. Because unfortunately, this is the fact that there is a lot of mis-selling in financial services at all levels. Your bank, I mean, I have known of retirees going to the bank to put their pension or PF money, and the bank trying to sell them an insurance product which is completely unsuitable at their stage of life. So
Ulips.
Yeah, ULIPs,
ULIPs.
and at all levels. I mean, you will see mutual fund AMCs launching thematic funds at totally the wrong time, when that theme has already run for a long time, is close to the peak, is about to go down. So that's why I said keep your, for example, equity investments broad and multi-cap or flexi-cap funds, rather than say that this is a time to buy defense stocks or this is the time to buy small cap stocks. And be vigilant with whichever professional you are hiring. Otherwise, at the very, very initial stage, there's no problem just deciding broadly this much equity, this much fixed income, this much gold I'm going to buy, and going and buying it from reasonably good, you can see now all mutual fund rankings here and there. So you, somebody who's in the not absolutely top, but who are in the top 25%, that is good. Don't keep changing all the time, because many times again, people who are saying that they're advising you may ask you to keep changing from this mutual fund scheme to that. Add, I've seen people with like 25, 30 mutual fund schemes, which is totally excessive, simply because it was making some commission for somebody along the way. So unfortunately, you also have to be vigilant. You cannot assume that every professional is working in your best interest.
I would say not just professionals, given that, okay, in the previous years, we had like unscrupulous bank managers, or there'd be like one uncle who tried to, sell you an LIC policy that you are just forced to accept because, you want to maintain that relationship or you don't want to offend them. I think all of us have that one LIC policy that we were forced to take. But it's happening at scale now with influencers, like people who have been paid to promote a financial product on the internet. And because of the large followings that they have, you do see people falling for it. So I I want to hear like both of your thoughts on this whole culture of influencers, as they're called, and how should one absorb the advice, because it's not like they're not making sense um, all of the time. They do make sense for 70 to 80% of the time, and then there's the selling that happens. How should one really learn to separate the wheat from the chaff, so to speak?
So first of all, buyer beware. So before coming to the general influencers, let me talk about all these courses that are offered on the net. Because that's another trap, because so many people go into this trading, that thinking they will make money, and all these things are sold to them saying what is 1% every day, it's so easy to make. So let me just give you the maths, that if you can make 1% every day, you can turn 1 crore into 20,000 crores in 4 years. So anybody who has this magic wand where they can do this is not going to sell you that in a course for 10,000 or 40,000 rupees. Recently, SEBI cracked down on one of these big guys who were selling. He's made 600 crores in course fees. 600 crores is not a small amount. He has losses on his trading book. He's never made a penny on trading. So please, all those things, anybody who tells you I can teach you trading and you can make money, please do not even go there. Do not even look at it.
Yeah, the only
Uh,
people making money from courses are the people who are selling the courses,
Selling the
not the
course.
ones who have actually
Right. So, and
used
as
them.
far as general, fin- I would say be very careful again for anybody who's giving financial advice on the internet, because they are mostly not authorized to give it, and they are just mostly pushing uh, something they've been paid for without disclosing they have been paid for it. So whether it's a crypto trading platform, whether it's something else, and even more dangerous are some of these people who might be giving you partly decent advice or analysis. So I have seen people who might give you the right advice on how to deal with the national pension scheme or something, but then they will suddenly in between also recommend XYZ fund without saying that they are being paid by XYZ fund. So half truths can be worse than complete lies. I have seen uh, even podcasts or people interviewing who told me that we do 3 4 normal interviews, and then we do 2 3 which are paid for, but we never disclose which are the ones who are paid for. So you have some of the good guys coming for their interviews, so it gives them credibility, but then they use it to push somebody who may not be kosher. So there are all kinds of models out there. So be very careful with your money. Most of us do a whole lot of research before buying anything else in our lives. If you have to buy a mobile phone, you'll make a checklist of all the pluses and minuses. And as far as our money is concerned, we will invest it based on somebody telling something on a Telegram group, somebody telling something in a party. So don't play fast and loose with your money. I always say that in Diwali time we worship Lakshmi Ma, but we do not respect the Lakshmi in our own lives. So please be careful about your hard-earned money.
Rohit?
Yeah, no, I think very nicely covered by Devina. I think the first filter would be that you go and seek advice for somebody who's who's helping, whose advice is helping you to become an investor and not a trader, right? Traders always make short-term profits. Investors always make long-term wealth. So that is what the goal and objective of everybody here is, right? So first filter is, go to somebody or any source of knowledge which is helping you to become an investor and not a trader. That's a filter number one. And the filter number two is the track record. Somebody who's done it for a 10-year period has built credibility in the ecosystem, right? And they have something to protect, something there because they built it over a period of time. It could be just like a doctor who has a credibility, a lawyer who's got a credibility, and they would not like to do anything which can, destroy that credibility. It's been there for a long period of time. And ideally, if this person comes to you through a known friend or somebody you know, somebody's wisdom you trust, somebody's judgment you trust, and who has used this person over a period of time, nothing better than that. Right? And in any ecosystem, there are good people and there are not so good people. There is a good cop, there is a bad cop, there is a good doctor, there's a bad doctor, there's a good lawyer, there's a bad lawyer. There could be a good financial advisor, there could be a bad financial advisor. But still we are able to figure out, good people in our lives, aren't we? We just need to be conscious that about our choices and all those filters, and we will find the right people in our lives. So I think that's the way you go about filtering. Somebody who's helping you to become an investor, somebody who's got a track record and a reputation to protect, and somebody who's coming to you with a referral of somebody who's used them.
Yeah, and I think a lot of that comes from being actively involved in your own finances instead of just outsourcing it as something that you don't want to deal with. Now, we have only 7 minutes, so I'm going to go to the last question before we open it up to the audience for questions. Devina, I'll start with you. If you could give a piece of financial advice for your younger self, what would it be?
I've already given it, which is that start early and be consistent with investing. Be conscious with investing. Don't play fast and loose with your money. Don't be at either end of this risk spectrum. And for any long-term goals, don't forget that India is not enough. When I started working, the dollar was 12 rupees. So in the course of less than a career, there's been a 90% depreciation. So when you're budgeting at 25 for 55, you can't forget that.
You, Rohit, what would you tell your younger self?
So I think it's very similar to Devina. I think the message which I would like to give all the youngsters, everybody, including everybody present here, is that, is the compounding. That is why Einstein called it the eighth wonder of the world. I'll give you a simple numbers. If you invest your money, say in a growth asset class like equities, which is expected, let us say, to grow at 15% per annum, it doubles your money in 5 years, becomes 16 times in 20 years, becomes 66 times in 30 years. So in a 30-year journey of investing your 100 rupees, in the last 10 years, it is going from 16 times to 66 times. That's how Warren Buffett became so rich amongst the top 10 richest people in the world. Bulk of his, two-thirds of his net worth actually happened to him after he turned 60. So you have to start early, bring in that beautiful atomic habit of, accumulating part of your earnings month on month for a very long period of time, and just then forget about it, because this is and then it will, after 20, 30 years, it'll just surprise you with a number.
I just add one thing to this, that, two big mistakes people make is to say that you should be 100% in equity at 25, or that you should be 100% in fixed income at age 60 when you are retiring. Both are not good advice. You should have assets in all categories at all ages, because at 60 you might still live for another 30 years, so you don't want to run out of money at 82 if you're going to be 90 plus. So
Yeah, yeah. And the hope is that you'll live longer. And I'll also finish by saying, you know, at 22, you think 42 is a very far time away, you know, because he was talking about 20 years. At 22, you might think like 42 is somewhere else. But I'll say that as someone who's edging very, very close to 40, it happens in a blink. So start as early as you can. We'll now open for questions. Uh, can the volunteers please help with a mic?
Okay, so I would like to
Sorry.
know your opinion.
Where can you wave, please? Yes, sir.
It's okay. I would like to know your opinion or your view on
on mic is not good.
okay, on investing, like
On index investing.
Index investing.
Okay, so passive investing sounds safe, but I will tell you where active investing helps you. That is risk management. That if the market tanks 30%, your portfolio does not tank 30%. So that's where it helps you. But if you just want quickly to do something, even index investing is fine. You know, nothing wrong with it.
Why? Because means that the way of choosing the active investing.
You just keep your mic up.
Okay. Overcoming the commissions and the financial advisors things. So it's very difficult to write. You have to screen and select the active mutual fund. So that's why.
Yeah, so I was saying that getting started with index investing is not wrong. Get started somewhere, then you can always refine your strategy.
Okay. Thank you.
Yeah, so my question was related to risk, and essentially I wanted your perspective on what you see the risk, let's say in the next 10 years, of the markets falling by, let's say, 50% from this level.
Risk is something you cannot foresee. I mean, that was one of Morgan Housel's lessons, that risk is always something you don't foresee. I mean, I'll give you an example. In 2022, January, The Economist made a list of all the geopolitical hotspots. So I think they had about 10 or 12 of them. And they did not mention Russia, Ukraine, which is where the war broke out the very next month. It was just, in February, the war broke out. So this is supposed to be somebody who's an expert in this. And life is a game of luck and probability. So you don't know for sure. I mean, in the beginning of 2020, first, of course, you could not have predicted COVID. But if I had told you that something would happen which would take travel, automobiles, retail, hotels, all to zero, would you have said there would be a bull market? So markets can be as unpredictable as that. So that is why you should not have money in equity, which you require for the next at least 7-8 years. Anything you need to withdraw in the next 7-8 years should not be in equity, because equity returns are not predictable. I mean, there was a whole 9-year period from 94 to 2003 where the Sensex gave zero returns. From the high in that period, it came down 40%. And the gold has seen drawdowns of 60%, 40% in the last 40 years. So that no one can say for sure that this won't happen. But over a period of time, if you remain invested, markets come back.
Yeah, so I think another way to understand that would be, see, risk nobody can predict. That's why it is called risk, right? But the way to manage risk is that, by extending your time horizon. I'll give you some simple numbers. If you would have invested in Nifty 50, or anybody would have invested in Nifty 50 on a daily basis for the last 10 years, then 30% of the times for 1 year return, 1 year every, would be negative. But if you would have invested for next 7 years or 10 years, each of the investments were positive. None of them were negative, right? So nobody can predict the future scenario, but if you extend your investment time horizon, the probability of you being in the loss, becomes less and less, and most likely you will be in the money. So that's the reason if you're investing in an asset class like equities, your time horizon has to be pretty long. It is a compounding asset class. It's not a trading asset class.
On the other hand, SEBI data shows that most mutual fund investors, majority of, this is like over 50% of mutual fund investors do not remain invested for even 2 years. So they don't see the compounding. Recently, one of the mutual fund, the AMCs, I think reached a 20 or 25-year mark. And they found there were only 23 investors who had remained invested through that period. So that's the thing.
Hi, my name is Manu. Any advice for retirees who just have a corpus to invest? Like, is it only defensive? Because if it's looking at mutual fund, usually SIPs work. But if it's just a lump sum which is available for investment for a retiree, how do we go about it?
It doesn't matter too much actually. If you even if you think the market is little high, you can invest it over a few months. But actually, it doesn't. Over a longer period of time, it does not really matter whether you are investing at the high or low of of a year. That's what data shows, that the difference is very little as long as you are consistent. But for retirees, as I said, the thing is that whatever you need to withdraw for the next few years should not be in equity, because in equity the order of returns matters. So if after you invest the first few years are down and you're still withdrawing money for your expenses, then your corpus goes down, and instead of lasting 25 years, you might run out in 15 years. A good rule of thumb is that your withdrawals every year should not be more than 3% of your corpus. That's a good rule of thumb to follow.
And also make sure you have really good health insurance.
Yes. Health insurance, if you can get from a corporation, either yours or your children, that's the best, because I can tell you most health insurers do not want to pay out. So they will try to wiggle out of individual policies. In a corporate policy, because more business is at stake, they tend to pay.
So I think, if you are a retiree in that situation, you have a choice between investing, say, in equities or fixed income, right? So if you are investing for a longer period of time, then the probability of a equity return, despite its higher volatility, to outperform a fixed income return is very, very high. So I think the way to plan this is, first of all, you secure your needs, which is your monthly income, your other life events for which you set aside that corpus, secure it in a fixed income kind of instruments, and then if you have surplus, let it just invest, for bare minimum 10 years. It will always outperform returns from fixed income over that period of time.
Okay, from here we'll take two more. I think they're already yelling at us from all these screens saying get out, get out. So we'll take two more.
Hello. Yeah. Rohit, I want to get your opinion on how global diversification is, considering rupee depreciation and kind of markets going sideways last year. So with Gift City also opening up, would you advise to kind of have a look at US ETFs and other global markets as part of the overall equity strategy?
No, that's a great question. So see, the problem is when you are living in an economy which is a growing economy, you think this is the only place where growth is happening. But the data tells us very different. While India is fundamentally, I think, pretty strong, we have a next 10 years very, very good for the country. I wish I was 20 years younger. But then the data tells us last 2 years, Indian equity markets have underperformed other equity markets, including last year. Diversification across economies, across geographies, across currencies, and across strategies also. And then there are other choices also available, which is like, if you don't want to utilize the LRS window, there are domestic feeder funds available, which pool in money from domestic investors like us, and then they will further deploy that collected funds into an international fund. So you can also go for those choices.
Last year, India's return was nowhere close to 10% in dollar terms. It was negative in euro terms. So we were number 36 out of 42 major markets last year. But global diversification is not something to be done on a knee-jerk basis that last year this happened, so therefore this over a period of time you should have 30-40% of your corpus in global assets, but don't do it on a one-year knee-jerk basis. And make sure whoever you're giving your money to has, again, some real global expertise.
Yeah, I think she had a question. She's been standing there for a while. Yeah.
Thank you so much. I have recently retired. It's an early retirement. I have most of my savings in mutual funds spread across equity and debt. My question is, to give myself a steady income for the rest of my living years, I've been trying to withdraw systematically SWPs from my existing mutual funds. So my question is, should I do that more, given what you were answering earlier, should I do that more from my equity-based funds, or should I take it out from my debt funds, or should I go into any fixed income like FDs and stuff? Should I get it out from there. So that's the question. How should I
can-
fund myself?
You should withdraw more from your fixed income funds in the beginning, I would say. That would be my advice.
Thank you.
Okay, one last question.
Ma'am, hello. Thank you for this session. And I just want to ask quickly about what is your opinion about smart beta indices? Our stock exchange has been coming up with a lot of smart beta indexes, and there are many funds also. So comparing the broad beta index funds with the smart beta indices, what is your idea?
See, I mean, one thing is for certain in markets that themes change. Whether it is asset classes, whether it's countries, whether it is strategies, whether it is industries. So whatever has done well in the recent past often doesn't do well in the next period. Even equity mutual funds, which are the absolute top, often fall just as rapidly, which is why I was saying that don't go for just that the best performing fund of late was this. So that is the whole point, that many of these strategies work for a while and then they don't work. It all, if you look at every strategy oriented fund, there were data, and I think Mint had done that every year that cluster of what does well is completely different. So there's no need to get that exotic. Just as I said, get a normal, get, at maybe 3 multi-cap, flexi-cap funds or PMSs and you are fine.
Okay, great. I think we should be wrapping up with that. Please do remember that both Devina and Rohit will be available to have a chat and sign their books as well right over here. So if you do have any unfinished business with either of them, you can complete it. Once again, thank you all so much for being such a wonderful audience and sharing your evening with all of us.
Thank you, Lavanya, and thank you everyone.
Thank you.